ब्रॉडकास्ट अभी तक नहीं किया है ना?
Your screen is blurred now.
मिश्रा जी ब्रॉडकास्ट स्टार्ट किया क्या? I think he's facing an issue. नेटवर्क इशू है क्या? मेरा फोन।
You are in
Are
your
you
office.
there?
Are you in institute office or your office?
No, today I'm in my office.
Where is your office?
Meera Road.
Acha.
Because आज मोदी जी आ रहे हैं बीकेसी में, तो उन्होंने
हाँ।
पूरा ब्लॉक कर दिया बीकेसी।
Yeah, अभी I know.
मिश्रा जी, are you there? Yeah, good afternoon, everyone. On behalf of Western India Regional Council, myself, Shweta Jain, Secretary, WRC, it is really my great pleasure to welcome you all on second day of this intensive refresher course on practical aspect of accounting standards. So friends, as in chartered accountant, we are known for accounting and auditing. And accounting standard are basic policy document, and it helps in bringing uniformity in whole accounting. So its main aim or objective is to ensure transparency, reliability, consistency, and comparability of the financial. So sound knowledge in this area is of course prerequisites, and but unfortunately we always take accounting standard as a last choice to read as a subject. But I think now time has come to take it as a forefront, and as an auditor we have to see that we adhere to the compliances. So keeping this in mind, we have designed this refresher course, and for today's session we have a very learned personality, CA Vijay Maniar sir, with us. So Vijay sir is having 35 years of experience, professional experience. 1985 to 1999, he was with Maniar and Maniar, Chandrakant Mehta and Associate. And then he worked with SR Botley and Company, LLP, since 1999 to 2021, wherein he was an engagement partner for statutory audit of large listed as well as unlisted corporates, including those which undertook capital market transactions in sector specifically focused on retail, pharma and chemical, packaging, hospitality, manufacturing and real estate. Extensive audit committee board meeting experience, having attending more than 400 meetings. He has been special invitee on accounting standard board of ICI for 2 years. He is a member of accounting and auditing committee of Bombay Chartered Accountant Society since more than 15 years. He is a regular speaker at various forums. His co-author of guidance note on division 1, 2, 3 of revised schedule 3 to the Companies Act 2013 issued by ICI. Also on revised schedule 6 to the Companies Act 1956 issued by ICI, and mandatory accounting standards extracts from published accounts issued by BCSE. Currently, he is an advisor and mentor to guide the Mumbai branch operation and teams, including the leadership team, to strengthen the practice in ASA Associate, which is a top 10 accounting and consulting firm in India. So with these brief introduction, sir, I welcome you at the platform of ICI, and thank you so much for accepting our invitation. So without wasting much time, I directly request to you to please take charge for the session.
Thank you, Shweta Madam, for the kind words of introduction. Good afternoon and good evening to all friends who have been attending. This is a virtual session. So we will see how do we make it interactive. Having said so, I really thank WRC for giving me this opportunity, because this has helped me in brushing my accounting standard knowledge. Over the period of last 5-6 years, we, or more than 6 years, we have all been looking at Ind AS, and somewhere in that process, at least I have missed my knowledge and brushing up the knowledge of accounting standard, and this opportunity, it helped me in brushing up my knowledge on key standards. And I'll be taking those key standards because I'll be taking income related standards. So everybody will look at what is the income of the company, what is the size of the company. So if somebody says size of the company is 500 crore, by and large it is a revenue number, correct? So it's always my pleasure to pick up these key standards, brush up the knowledge. And what I've done is to make it little more interesting, because accounting standards have been there for so many years and we have learned it, but I've tried to convert it into a kind of case studies. And what I would suggest is, if you could respond to your response to the case studies as and when it comes. So theory is minimal. If I were to say, majority is the case studies. This case studies is based on my experience of what kind of issues which I encountered and what was the solution to those issues. Having said so, I'll be happy to respond to any questions which you would have. And if you can put your comments in the chat mode, I'll be happy to respond as and when it is possible. Is my screen visible?
Yes, sir. Yes.
Okay. So I am going to take these 4 standards. Now is it visible or it's gone?
It's
It's
visible.
visible. Oh, but I can't see it. I can't see my screen. I can't see my screen.
Try to shift it up. I mean, maybe page.
No, that's what I'm trying to. Is it fine? Can
Yeah,
everybody see me?
yes, we
And the
can
slide,
see.
and the slides,
Slides
right?
are not moving.
Yes, yes.
Okay.
Slides, yeah, slides have now started.
आप स्लाइड पे एक बार माउस क्लिक करेंगे ना, फिर नेक्स्ट करिए, फिर नेक्स्ट होएगा. हाँ, अभी नेक्स्ट करिए. हाँ, नेक्स्ट.
Is it moving?
Yes sir.
No.
Yes.
Yeah,
Yes
now.
sir.
Yeah.
Yes, yes.
Sure. Okay. So as I mentioned, so as CAs, we need to now get into this technology also. And there are always some or the other technological challenges, and we'll master it, over the period. So sorry for this. So as I said, I'll be taking these 4 standards, which are A7 revenue recognition, this is for construction contracts, AS9 for the normal revenue recognition, lease accounting, and government grants. We'll deal with brushing up of some of the theory aspect before getting into the case studies. So first is the revenue is the gross inflow of cash receivables and other consideration arising in the course of ordinary activities. So what is important is it is the ordinary activities from where if it is arising, then AS9 is applicable. If it is not arising out of ordinary activities, then there would be other standards which would be applicable. And what is important in revenue recognition is it's the timing of recognition, which is the most critical. It's not only timing, but also the measurement of revenue. Why timing is important is, as I mentioned, if somebody says my company is 100 crore, then it is the 100 crore what we talk about is the revenue of the company. The stakeholders looks at the revenue of the company. And the timing of revenue recognition is one of the most important aspect for us as auditors. In fact, we need to as per the auditing standard, we need to ensure that timing of revenue recognition is correctly it is accounted on a timely basis. It should not be accounted, and it is accounted in the period in which the revenue is earned. It should not be in the previous accounting year or the reporting period or the subsequent reporting period. And hence cutoff is one of the most important aspect of revenue recognition. In fact, if you see a lot of times there are some or the other schemes which are going on, and those schemes could be during the month end, quarter end, or the year end. And the primary purpose of such schemes is that the company wants to maximize its revenue. And in the order to maximize the revenue, companies may adhere to not the correct accounting, because either the stakeholder, all the stakeholders are looking at it. So it could be based on the revenue, there are some bonuses which are determined, or the bank limits gets determined, or if it is the shares which are listed on the stock exchange, then the market price of the shares are determined. And hence the timing of recognition is very important. Of course, as I said, that the measurement is also important. This standard does not deal with revenue arising from construction contracts. This will deal with separately, as I mentioned. Then revenue arising from hire purchase and lease arrangement, that also will deal with it separately. Government grants and other similar subsidies, that also will deal with it separately. And revenue from of insurance companies arising from insurance contract, that we will not deal with in today's session. So as I said, AS9 deals with primarily from the sale of goods, rendering of services, interest, royalty, dividends. So, use of companies' resources. So, in terms of money or the rights or the investments, and how, this needs to be determined, we'll have to see. Now, there are certain exclusions, and which are not, and rightly so, this is not considered in this standard. Anything which is unrealized is not to be considered. So unrealized gains from holding non-current assets. So if any of the fixed assets are, revalued, this is not the standard one is to look at. Or if there are any unrealized gain from holding current assets, if there is any increase in the value of those current assets which are realized or not realized, it is not to be considered. Including realization of some of the realized gains which are not in the ordinary course of business. So for example, disposal of say fixed assets, if there is any revenue or profit from this, that is a separate standard which deals with it. Or if there is any liability which the company has accounted, and subsequently the liability is settled at an amount which is lower than the carrying amount, that is also, this is not the standard for this. And also there is foreign exchange, there is a separate standard on foreign exchange. So these are the exclusions. So idea is that revenue is primarily from those arising from the ordinary activities of the company. Most important, when do we recognize revenue? So revenue is recognized when the ownership has been transferred. And with the complexity arising, a lot of times the ownership does not get transferred, but risk and reward incidental to ownership gets transferred, and hence both are covered, and rightly so. So either the ownership is transferred, or the risk and rewards which are incidental to ownership. So as if, even if company does not own it, but the risk and rewards of those assets or goods belongs to the company, then the revenue can be recognized. And secondly, of course, unless there is a reasonable certainty of consideration and its ultimate collection. So two things, risk and reward should be transferred, and there should not be uncertainty of the ultimate collection of the revenue. Let me start with the first example. I've got 25 examples. We may, depending on how you respond, it will, I've tried to make it interesting. I would urge you to respond in the chat mode, chat box which is there, so that at least we can make it interactive even if we can't see each other. So A Limited has entered into a contract with B Limited to dispatch goods valuing 25,000 rupees every month for 4 months upon the receipt of entire payment. B Limited accordingly made payment of rupees 1 lakh. A Limited already had goods and started dispatching as per the instruction. So this is the money received in advance. 1 lakh has been received in advance, and the agreement is that 25,000 every month for 4 months will be goods worth 25,000 will be sent to B Limited. In the third month, due to natural calamity, A Limited is a seller, communicated to B Limited that there would be delay in delivery, though it is holding the remaining goods worth 50,000 ready for dispatch once the situation improves. And A Limited accounted on all the money, amount as sales as the entire money has been received. Any views on the accounting? Can A account, entire money received even if A could not deliver goods because there was some natural calamity? I request you to write it in the chat. I'm not sure anybody is written because I cannot see any chat message. Mishra ji, can I see the chat?
सर आप क्वेश्चन में देखिए सर.
Sorry?
चैट में मत देखिए सर, क्वेश्चन में देखिए.
किधर देखूं मैं?
क्वेश्चन बॉक्स में है ना सर.
क्वेश्चन बॉक्स, हाँ हाँ, ओके,
वहां पे देखिए.
ओके. Okay, I can see that now. Okay. So, Pramod, I think, since risk and reward is not transferred, when the risk and reward of this will get transferred is when the goods are sent, and then depending on the Incoterm, when the goods are either shipped or received or whatever are the terms and conditions. But today, the risk and reward of the goods is still lying with A Limited, and hence this balance amount, though amount has been received, A is holding that amount. It is because there is a natural calamity. A has requested to that A is not able to deliver, and hence if tomorrow something happens to those goods, A Limited will still be responsible. So the risk and reward of the goods is not been transferred, and hence A Limited cannot recognize that as a revenue. This is a similar case study where it is, so what is saying is that, in this case, the natural calamity is at B Limited, and B Limited has requested A Limited to dispatch goods, not to dispatch till further notice, and A Limited is holding remaining goods. Here, A Limited has now accounted. So earlier, this was that A Limited, the seller could not sell because of natural calamity at seller's end. Now there is a natural calamity at the buyer's end, and buyer is requesting that please hold these goods for me, and I will inform you when these goods needs to be dispatched, and that point of time you dispatch. So here the question is different. Now the buyer is requesting. Earlier we discussed the issue where the seller was requesting. Will it change? That is my question. Anybody answer? Correct. So I think most of you are right here. So there is a concept of something called bill and hold. So if the seller has billed and holding the goods on behalf of the buyer, and buyer is requesting, and hence the seller has those goods lying with it, and hence it may be appropriate to account for the revenue. One has to look at terms and conditions of the contract, but this is a common practice of seller keeping the goods ready, waiting for the buyer, holding it on behalf of the buyer. Now one has to look at whether the risk and reward. So tomorrow, if the value of that goods which has been identified for the buyer, if there is a variation in the prices, then it is on account of the buyer, not seller, because seller is holding those goods as a trustee, as a bailee of the buyer. But as I said, one has to look at terms and conditions of such arrangements to evaluate whether the seller can recognize that sale, even if it is holding, it is not dispatched. The idea is that please be mindful of this. My idea is, as I said, these are all based. What I've given is based on my experience of the kind of issues which I've handled, and hence be mindful of the arrangement. Each arrangements are different. Each arrangements are becoming complex. They are becoming more and more complex. The transactions are becoming larger and larger, and hence the impact on the financial statements could be significant, and hence please be mindful as to what are the arrangements. When we audit, cutoff is one of the, as I said, very important aspect of audit. In fact, the cutoff is considered as a fraud risk. So if it's a fraud risk, the level of auditing procedure which needs to be done is higher than the normal risk, right? So hence it is very important that why, you know, the revenue which has been accounted is appropriately accounted. It could be, you know, depending on, we do not understand the kind of challenges which the management is facing, and hence our responsibility is only to review the contract, review the arrangement, and accordingly decide whether the revenue is appropriately accounted in the correct period. Coming to the, you know, next question, which is a different one. Now let's move away from this bill and hold. So it's the earlier one is typically called bill and hold arrangements. So this A Limited sold and delivered goods worth 50 lakhs to B Limited. Now B Limited is a large retailer, and B Limited has 100 retail stores all over the country and houses various brands. Correct. So we see, you know, so many retailers and retailers selling other brands, FMCG products, and all this. So these are, so A Limited is the seller. I've made it consistent. A Limited is the seller, B Limited is the buyer, so that you avoid any confusion. The key terms of the agreements are is as under. B Limited will place order-wise, store-wise order, which will be delivered by A Limited. B Limited will have right to return unsold goods. So if, you know, out of 50 lakhs, anything which is unsold, B Limited can deliver. Credit period is 90 days. Selling price is MRP decided by A Limited seller. However, the buyer can offer discount as it deems appropriate, and A Limited will share the discount provided by B Limited. Here the issue is that the seller has sold the goods to the buyer. Buyer has 100 stores. So buyer will try to sell all these stores, goods, but if for any reason those goods are not sold, then the buyer will have a right to return those unsold goods. Also, buyer may, depending on the competition or other factors, may offer some discount, and the seller will also share the discount. Now in this case, we need to, again, we go back to the original. What are the concept is risk and reward, and number two, whether there is a reasonable certainty of the revenue. So what is, anybody want to guess how this revenue can be, what is the revenue to be recognized by A Limited, which is a seller? Any guesses? Buyer has right to return after invoicing, say for if it is for 100 rupees, seller may buyer may offer discount to ultimate customer. So we go and see, there are all the discounts which come. So how would the seller in this condition will account for revenue? No guesses? I'll wait for a minute, otherwise I'll start. I'm saying it's more interesting if we make it interactive. Correct. So I think, Pramod, you have hit it on the nail. So what one has to do is based on the past experience of sales return and past experience of the discount. seller will have to, account for it. So if seller has sold goods worth rupees 50 lakhs, right? So 50 lakhs, out of which, say, in the past, how much returns were there, and one can look at, there are some, there is no right or wrong answer, but one has to look at the past trend. The past trend may or may not be representative of the future trend. However, based on the past trend, seller can say that, okay, based on the past trend, there were 5% or 10% of the goods which I return back. So make a provision for 10% of the goods, and based on the past trend, I participated in the additional discount of, say, 5%. So 10% as the sales return and 5% as the discount. The seller will account on a estimate, and it's a estimate which the seller is making, and will recognize revenue accordingly. And as and when, this sales get crystallized, seller will update the estimate. Here the estimation calculation becomes a very, very important and very, very critical, because this could be a significant portion of the seller. And how this what is the basis, what is the past experience? As I said, past experience may or may not be representative of the future. However, it's one has to look at the past, adjust to the any current circumstances which are there, and accordingly account for it. The next question is is similar. In the first case, in the earlier case study, what we saw was that the goods were there was a credit period of 90 days. Here, what it says is so the buyer will have a right to return unsold goods, and buyer will make payment only when the goods are sold to ultimate customer. That is a difference. Otherwise, the case study remains the same. Buyer will place the order. Selling price is as decided by the seller. However, buyer can offer the discount, and the discount will be shared between buyer and the seller. In this case, will there be any difference in the accounting for revenue recognition? Any guesses? No response. Okay, so so let me take this forward. So yeah, okay, there is some reason. So I think Megha, you are right, and this becomes a challenge. I've seen there are divergent practice here also. Some companies I've seen accounting based on the earlier examples, so that based on the past trend, that sales return and discount is accounted. However, in my view, the correct view is that there is no sale. The property in goods has not passed. Since the property in goods has not passed, this revenue can be recognized only when the ultimate sale happens to the ultimate customer. So the ultimate buyer of the retail store, when that buyer purchases, that is the time A Limited can recognize sale, not earlier than that. I'm saying, please read if you are dealing with any of the supplier to the retailers. Please read the agreement very, very carefully. each agreement is different, each brand is different, each time when they sell, those those conditions could be different, and hence this is something which one has to be mindful, that there is no property in goods has not passed, and hence revenue cannot be recognized. This is a little twist now. It says that A Limited will, so in both these cases, B Limited was placing the order and which was delivered. So the buyer was placing the order and the seller was delivering. In this case, based on the past experience, seller itself is shipping goods to the different stores of the buyer. Buyer will have unlimited rights to return the goods. Buyer will make the payment only when the goods are sold to ultimate customer, and the discount it is similar. Is there any difference now? And here we need to look at accounting treatment of both A Limited as well as B Limited. So the buyer, the seller will decide which store, what goods to go. The buyer will sell, will make payment only when it is ultimately sold. Buyer will have right to return unsold goods, and the discount sharing we have discussed. So how the revenue needs to be recognized for buyer as well as seller? Any guesses? Very interesting. If you are doing audit of any of those who are supplying to retailers, you will find all sorts of perfect Salgia. It's more like a consignment, but one has to look at the terms and conditions. So if it is a consignment sale, then the revenue recognition changes. If it is a consignment sale, then the retail store it's correct. It is Harish, you are right. It is it's more like it's a consignment sale, and hence the seller will account only the net amount. Seller, so if the seller is purchasing for say 100 and selling at 130, seller's revenue is only 30, not 130, right? So sorry, it's a retailer. So retailer's revenue is only 30 because retailer is getting only 30 rupees as the commission. Yes, Harish, you are right. It looks like, so as I said, one has to look at all the arrangements. So it's more like a consignment sale. If it is a consignment sale, then the retailer will account for the revenue on the net basis, which is the difference between buy price and the sell price, and the seller, which is A Limited, can account for revenue of 130 because 130 has been sold to the ultimate customer, of which 100 is the one what is the cost, and hence um, one has to be very careful in reading what are the terms and arrangements of the agreement. Let's move away from here to some other arrangements. So A Limited is now the seller is selling machinery to the buyer. The selling price is 50 lakhs, credit period is 120 days. B Limited has provided guarantee of 1 year and warranty of 2 years, right? We get all this 1 year guarantee, 2 years warranty. B Limited has history of successful delivering machines. However, there have been also history of replacing machines. If within 1 year, if there is something goes wrong, then it's a warranty. It needs to be replaced. So 1 year there is a replacement. After 1 year, it is a warranty. Warranty means, we can only repair. It will not, replace. In this case, how would seller, which is A Limited, will account for the revenue? Selling price credit period is there, which is 120 days. There is a guarantee of 1 year, warranty of 2 years. The seller is usually, selling this, but it is possible that they've also replaced during the guarantee period. The machine was not functioning well, so it has been replaced. Also, there is a warranty of 2 years. So Mega, you are saying recognize revenue on completion of guarantee period. And Sandeep, you are saying basis past experience to provide for replacement and repair cost. Correct. So here, so both, so Mega, since the company has the history and the property in goods has passed, and hence it may be appropriate to recognize revenue. But say if the company is selling several machines, and out of several machines, again based on the past trend, there has been some machines which are not being functioning well, and those gets replaced. So to that extent, revenue needs to be reduced. So for example, if the company out of has the history of say 5% of the machines which get replaced, then company has to make a provision for 5%, because 5% machine which need to be replaced, and hence 5% is the revenue which needs to be reversed. Also, the warranty cost, now warranty depends on three options which are there. Two options are there. The right option is, since the price is inclusive of warranty, the company has to carve out what is the warranty value and amortize, recognize this warranty income over the warranty period. So if warranty is for balance 2 years, then the company can say that based on the past experience, either what is my warranty cost which comes in, or if the company separately takes the warranty as the business to provide for warranty and for a fee, then that is the value which can be deferred, which can be recognized over a warranty period on a straight line basis. So two things: replacement needs to be provided, and warranty based on the past experience, or if it is a separate service which or business which the company is doing for a fee, then that can be the amount which can be provided, which can be recognized over the period of the warranty period. So we saw revenue. Normally we saw revenue in the case of manufacturing. Now let's look at something on trading cum manufacturing. So A Limited, which is a seller, sells chemicals to B Limited on following key terms. Selling price is 50, credit period is 90 days. Now there is a discount. So B Limited will be entitled to quantity discount on annual basis. If B Limited buyer purchases between 100 to 500 kg, then 2%, 501 to 1000, then 4%, and 1001 to 2000 and above is 6%. Now, till now, A Limited has invoiced 500 kg till September, and the company is, preparing financial statements. That is a cut, for some purpose, and hence how do company account for the revenue? So there is a graded discount. The graded discount is based on uh, 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 the quantity which is lifted by the buyer, and there is a cutoff in between. In this case, how do one recognize revenue? That is the question. So, uh, so Pramod and Salgia, I think here one has to get into the estimation mode, because what you are mentioning is that, ignore the balance period. But what happens is there is a sale which has been done in the current period, the impact of which can be felt in the subsequent period. And hence, if there is any sales which needs to be amount which needs to be returned to the customer, or based on this condition, there is a further discount which is applicable. And hence, while drawing the financial statements at a cutoff period, one has to look into the future, estimate the additional discount which may have been have to be provided, and account for it. It's a estimation process, again based on the past trend, current condition, provide for. So we get into the estimation. The property in goods has passed, so we recognize revenue. The amount is there, but it is possible that we may have to return some amount, and hence we provide for the discount. Now here the example is similar. Okay, there is a, based on the quantity which is lifted, there is a discount. In addition, there is a discount which is given by the seller to the buyer if the payment is made within 7 working days. So there is a 2% discount if the payment is made within 7 days. Now, it is expected that all this amount, all the payments made will be made by the buyer within 7 days, so that the buyer can earn 2% cash discount. And there is a cutoff, there is some amount which is still outstanding. How would you, in addition to the earlier discount, how would you account for the cash discount which the buyer is entitled? Come on, Harish, Pramod. Poonam. So Pramod, what you are saying is cash discount should be reduced from price itself. Now, see, cash discount is not, so quantity discount is reduced from sales. Cash discount is not a trade discount; it's a cash discount, and hence it is earned when it is paid. If it is not paid, it's an option, and the buyer may not take the option. And here the question of estimating into future does not arise. The once the buyer makes the payment, it is accounted. If the buyer does not make payment, it is not accounted. That's the difference between trade discount and the cash discount. Cash discount is accounted when the actual payment is made. Trade discount is accounted looking into the future if there is any impact likely to be on the sales made for the past. Now let's take a case of the specialty chemical. The condition is in this case, when there is any specialty chemical, B Limited will test the chemical in its laboratory, and if it is not if it is not up to the quality, then it can return the goods. B Limited will take 7 days to test the chemical, and the credit period is 90 days from the date of invoice. How do you account? So here the seller has sold the goods, the buyer has received the goods, the buyer will test the chemical in its factory, and if it is not found to be of the quality, buyer can return the goods, and it takes about 7 days. So should the seller account upon the normal conditions or after 7 days? That is the question. So Suman, what you are saying is suggesting is goods sent on approval, and hence should be accounted after 7 days. Whereas Salgia is saying sales to be accounted on being invoiced considering past history. So here, there are no right or wrong answers, because all the time, whenever the company is selling, there would be some testing which will happen, and if the goods are not up to the quality, then those will get returned, even in the normal course or otherwise. So here, both options are possible looking at the past trend, but I think what the companies normally do is based on the past trend, as Salgia is saying, based on the past trend, provide for the returns, because it's a goods which the company is confident that its company is in the business of specialty chemical, company has been doing such business. By and large, this gets accepted. So if sometimes there are returns, and hence there is no need to wait for 7 days, but provide for the based on the past trend, provide for the returns. Now let's look at agrochemicals, right? This is where normally there are 2 seasons, Kharif and Rabi, and that is how what happens is here the buyer seller is selling goods to the buyer. Buyer will sell these chemicals to the farmer depending on the monsoon and other weather conditions. If these are not sold, then buyer can return the goods, or the seller can offer additional discount, because there are logistics costs which are involved, and the credit period is 9 days. How do you one account for it? So here the seller is selling goods to the buyer. Buyer is in turn selling it to the farmers. Now farmers will purchase the chemicals depending on the monsoon and other weather conditions. If the weather conditions are not favorable, then the buyer will return the goods to the seller. Or if there are logistics cost involved, it is possible that the seller may offer additional discount, because there is a cost of return. So can offer additional cost discount to the buyer. So how do seller account for such sale? Anybody? Okay, so let me. So I think we discuss. Okay, somebody is back. Correct, Salgia, you are right. So we discussed this issue in the retail. there could be possibility of return or the discount. This also is the similar. So based on the past trend and the present condition, including one has to look at event after the balance sheet date, is there any significant returns, no returns, accordingly make the provision. So this was on the revenue recognition as far as the goods are considered. Then let's come to the services. So services, there are two methods of recognizing revenue. It is either on a proportionate completion method or on a completion method. However, one fundamental this is there is no uncertainty of consideration and its ultimate collection is reasonably certain. In this case, let us look at few examples. But before looking at let's look at some theory. So what are the two methods? As I said, proportionate completion, completed method, correct? Proportionately, with depends on what is the proportion percentage of completion, and we'll see what are the methods. And completed services when it is substantially completed. So for example, all of us or most of us will account for revenue as a chartered accountant, will account it on a cash basis. Technically, it is a completed service basis, right? And hence it is on a, so when it is completed or substantially completed, and that is where this is there. Now let us look at couple of examples. So A Limited is a software development company and an expert in accounting software since past 10 years. It has developed several vendors for installation of its software, and the customer is free to engage either A Limited or any other vendor. Correct. So it's a something. So customer is let's look at Tele. When I'm saying, I'm not saying about Tele, but I'm just saying something which is easy to install. A Limited has agreed to sell accounting software to B Limited on the following key terms. Selling price is 3 lakhs, which includes license fee, installation, warranty, and all free upgrades for 3 years. And credit period is 90 days from the UAT date. So how should A Limited account for the revenue? So A Limited is into software development. Right? It is an expert in software development. It has been doing it in the past. It is sold accounting software to B Limited, which includes license fee, installation, warranty, and all free upgrades for 3 years. And the credit period is 90 days from the user acceptance day. So the day first installation happens, within 90 days, this amount will be paid. How should A Limited account? Harish, your question I have not understood. What are the indicators to check the ultimate collection is? So ultimate collection is certain is, is there any uncertainty? When seller is raising invoice, it is accounting as a revenue. Now at that point of time, is there any uncertainty as the property in goods has been passed? So Salgia, what you are saying is on the date of UAT. So this is what you are saying is completed contract, which will be there, which is a fair. So companies do it differently, since this is a software which is easy to use, easy to install. Company has various other contractors, has been there in the history. So company can decide. What happens is, if you see any of the contracts, the contract terms will have various amount. So we'll say license fee of rupees so and so. installation fee of rupees so and so. Correct. And then what is the obligation is that we'll provide all the updates, we'll provide for free warranty. So if it is a easy software to be implemented, then one can recognize license fee when it is sold, installation when it is done, or installation over the period if it is a complex installation. So somebody say SAP. So SAP will sell license because they've been in the business, but its implementation is complex. Implementation will have a separate stream of revenue because implementation can be done by different agencies. And if the SAP itself is doing, then over the period of installation, based on some percentage completion, it can recognize revenue. And the warranty one is to uh, uh, look at based on the past trend and provide for the warranty. And that warranty can be over the period. There are two ways companies provide in Indian GAAP. One is provide for the warranty cost based on the past trend. The other and the more conservative way is to provide recognized revenue for warranty only over the period. So one is to look at the history, look at the past trend, and accordingly recognize revenue. Here, there is some twist. Lot of times, even in the software, there are targets to be achieved, there are licenses to be sold, and hence they have given some twist over here. Is the selling price is the same, correct? 3 lakhs with warranty and all upgrades for 3 years. As there are a lot of regulatory changes expected to occur, which can significantly impact accounting software, and there is likely to be reorganization of buyer, B Limited. A Limited has agreed to provide all the upgrades, including regulatory changes, as well as other upgrades as requested by B Limited. So over the period of 3 years, what is A Limited going to do? A Limited is going to first sell the license. Second is install. Third is the warranty. Fourth is all upgrades which A Limited is doing. Fifth is all the regulatory changes committed, whatever regulatory changes happen. And the sixth is whatever is the buyer wants, because buyer is planning to reorganize. So whatever is the buyer is planning to reorganize, what changes, that also A Limited is committed. And the credit period is again 90 days from the UAT date. Any guesses? So correct, Harish. So here what happens is, if one does not know, number one, what are the regulatory. So there are two ways of upgrades. Upgrade is the one which the company itself will do upgrades. So there is no commitment. The other way of, in this case, there is a commitment. Commitment is whatever regulatory changes are there, will make, or whatever changes you want in the software will make. And hence there are several services, and it is very difficult to put the efforts, because future one does not know, and there is a commitment to the future. And hence in this case, in my view, revenue should be recognized on a straight line basis over a period of 3 years, or any other rational way, but one cannot recognize revenue upfront, because there is a further commitment. We have not performed our obligations, and hence there is a deferment of revenue as against the earlier. Yes, Harish, equal recognition is also one of the way, unless one has to look at any rational way of recognizing. As I said, there is a commitment. So today I'm giving license, today I'm installing. However, there is a further commitment. So it can be a, if there is no other basis, equally over the period of 3 years can be the one which can be accounted. Now there is some twist here. Earlier two cases, they were expert in developing the software. Here, the company has started develop its own software, and the conditions is that there is a selling price. So when somebody is starting for the first time, they've done it at 2.5 lakhs as against 3 lakhs, which is the price. Correct. The selling price includes license fee, installation, and all upgrades for 3 years. And there is a credit period of 90 days from the UAT date. In this case, how would one recognize revenue? It's a new, so companies have started this new, first time they are selling. Companies selling license, software, installation, warranty, upgrades, and there is a cutoff. So company is entered into sale, but the installation is in progress. So in the last one, what we said is it should be equally. Here, the performance obligation is, since there is no history of developing and installing that software, in my view, it may be it's a better way of recognizing is once the UAT is done. I think on the date of UAT, Salgia had given in the first example, but in this example, once the UAT is done, that is the day one can recognize revenue. Of course, provision for warranty is there, and free upgrades. Free upgrades is the one which the company may decide to have the upgrades, may not have decide to have upgrade. But here the UAT is very critical. Before UAT, I feel it will be very aggressive accounting if the company were to. So we know, yes, you are right, only when the installation is complete, which is a UAT date. But one thing which is important is, as we discussed in all this, we need to recognize revenue when the ultimate collection is reasonably certain. So if the ultimate realization is not reasonably certain, we defer the revenue, and hence we provide for returns, we provide for discounts, right? And all this is done on a conservative basis. However, when there is a uncertainty which arises, so that is a change in the estimate. If there is a movement in the returns and discount, it's a change in the estimate, and this will get reflected in the revenue account only. But having sold, say, chemical, or having sold goods to retailer, if the retailer does not make the payment, then it's a provision which is required to be made, and it's not a reversal of revenue, because the uncertainty is arising subsequent to the reasonable certainty of ultimate collection, and hence it is not the reversal of revenue. However, it is a separate provision for bad debts. Then also this standard deals with interest, dividend, royalty. So interest should be on the time basis. If the company has got any investment, say in bonds of other companies which are purchased at premium or discount, then premium or discount needs to be amortized into the P&L based on either on a straight line basis or based on the basis which gives a similar return over the period. So for example, if the company has purchased any bond of 100 rupees at 102 or 98 rupees, the 2 rupees can come into P&L on either on a straight line basis over the period, or in such a manner that company gets similar return accounts for similar return over the period of the bond over till the maturity. Dividend is on the AGM dividend, which is declared on the AGM as against in Ind AS. It is on the date how it is received and paid. Sorry, and royalty is also based on the conditions. Let's look at one more condition. This that the company has lent money to its subsidiary in Sri Lanka. Now, there are the subsidiaries profitable with healthy reserves. However, there is a challenge in Sri Lanka, and Sri Lanka has stopped any foreign remittances. And the company, the money is separately lying idle. For 3 quarters, the interest is pending. How should the lender, which is A Limited, should account for interest while closing its books? So A Limited is a lender. It has lent in Sri Lanka. Sri Lanka has very serious foreign exchange challenges. The borrower is healthy, borrower has funds. How would the lender account for the interest? Anybody? So here, I think, so here the issue is that if there is some restrictions which are there for the remittances. If it is the normal course, there is no issue and the lender can account for it. But in this case, since there are serious challenges, it will be difficult for the lender to recognize that as a revenue, because even if the borrower is healthy, but if there is no permission which is received, borrower will not be able to remit the money. And today, in a foreseeable future, it seems difficult that it may get permission, and hence it may be appropriate for the lender not to recognize interest. It is the similar, if there are export incentives, if the export incentives there is a reasonable basis for recognizing, then export incentives are recognized when the exports are done. Although all the paperwork and all takes time, but if there is uncertainty, if there is lack of clarity, right, or suddenly government stops disbursing and there is a huge backlog, in which case it may not be appropriate to recognize export incentives. So I'm just trying to say export incentives interest. So one has to look at are there any conditions, reasonable certainty of recognizing revenue. This is a different one. If we were to recognize revenue on our revenue, which is a CA's revenue, on a accrual basis, how should we account? Because currently it is on cash basis, most of us are accounting. But if we were to account revenue on a accrual basis, means why I'm giving this example is we can relate with this, and accordingly all the service companies we can relate. So I'm saying a chartered accountancy firm specializing in audit and keeps books of account on accrual basis. It has got a mandate to do statutory audit as well as limited review. It's a listed company. The fee is 50 lakhs, 5 lakhs per quarter for limited review, and 35 lakhs for the year-end audit. A Limited has estimated 3,000 hours, which includes 250 hours per quarter for the limited review for audit of for this audit they will need various resources right from articles to partner. how should A Limited, LLP account for the revenue when 3 quarters, when we close the accounts for March, normally 3 quarters audit is done, June quarter, September quarter, December quarter. Lot of work for March has started, but March audit is not complete, which is on 31st, 21st of May. So as of the cutoff date, how can we recognize revenue? Any guesses? Have you come across such situation? No guesses? Account revenue for 3 quarterly reviews. That's Salgia. And all four quarter less some provision, which is Vinod. So I think here three things we need to keep in mind. Number one is it's a single contract, right? So single contract. So the first question is, should we recognize revenue evenly for the single contract, which is contract is 3 limited reviews and 1 year-end audit. Though the fee is different depending on the hours. So one can either do, and right way of doing it is there is also some leverage which happens when one does limited review and does the year-end audit. So the ideal way of doing it is that what is the effort? Based on the effort, so it says 3,000 hours. Now one has to then split this 3,000 hours into what is the resources which is comprising of 3,000 hours, which is articles to partner, and each article to partner will have a different cost, right? So depending on the time which the article has spent, depending on the time the qualified has spent, depending on time the seniors have spent, it's a different cost structure. So the ideal way of doing it is what is the cost actually incurred based on the time cost hours incurred by people at each level and compared to the revenue. And then first look at whether 3,000 is the right, because it's an estimate. So first look at whether this is the right estimate. What is the balance cost to complete when we look at? So what is the balance cost hours required? Because at the later time, a more senior time will be required because it's a year-end audit. So the cost may be higher, and hence the revenue recognition may be higher for the next year as against this year. If so one can look at hours, which is a very crude way of looking at it. One has to then multiply hours by because articles may spend more time in the initial period. The seniors will come in at a later period, and hence it may be appropriate to look at differently. Idea is that I just wanted to give you as to how if we were to account it on a accrual basis, how can this be done? This is the disclosure requirement. I'm not getting into it now. Now let's look at the next is the construction contracts. So here what happens is in the AS9 revenue recognition, by and large, the revenue is recognized, purchase and sale is done during the year. But in case of a construction contract, which falls into different accounting periods or different years, it may take, so if it is a real estate or dam, right, bridges, it takes long period of time, and hence the idea is that how do we recognize revenue when there are projects which cuts across different accounting period. So it says contracts specific. What are the construction contracts? It says construction of an asset or a combination of assets which are closely related. So if there is a construction of a dam, correct, or a bridge, it is a contract. If there is a construction of a real estate comprising of 5 towers and all the facilities, it could be combination. One has to look at it differently, but I'm saying the idea is that it's a single project, a single township. How would one look at the contracts? Whether one looks at each tower as one contract or the whole 5 towers as single contract? So one has to look at differently depending on the terms and conditions of each contract. It also includes contract for services directly related to construction contract. So it also looks at services and contract for demolition and restoration of assets and restoration of environment after the asset is demolished. So, post and pre, this also is part of the construction contracts. It's important, whether the contract is a single contract or a separate contract, for the reason that the revenue recognition changes, and hence it is important when one looks at it, if one reads the contract and if what are the terms and conditions, are there any linkages with other contracts, one has to read those very carefully to determine whether it's a single contract or a separate contract. So if any contract which is negotiated as a single package or closely interrelated contracts with overall profit margin. So we may have negotiated different contracts, but we've said, agreed that, okay, because of this, there is a profit here, loss here, or different margins, but negotiated as a single interrelated contract. Hence, it's a single contract and perform concurrently or in a continuous sequence. If it is not there, then it's a separate contract. Also, it is possible, how do we segregate those contracts into a separate contract or a single contract? So if it is a separate proposal for each contract, correct, or separate negotiations, and cost and revenues are identifiable to each of the contracts separately, then it's a separate contract. Otherwise, it's a simple contract. It becomes complex, once we read one contract, we may not, understand whether it's a single contract or if there are any linkages with some other contracts. So this single contract needs to be aligned with some other contract. So one has to read those terms and conditions very, very carefully to evaluate whether it's a single contract or a combination of contract. There are 2 types of contract. One is the fixed price, correct. So if it's a fixed price contract, most of the contracts may be fixed price, but there could be subject to some escalation. So for example, lot of construction contracts are, say, fixed price with a base of, say, cement and steel pricing. And if there is any movement above or below certain percentage of those pricing, then those contract gets changed. The value gets changed. Or it could be cost plus. If there is a cost plus, then also it is possible that it's not all cost plus straight, it's a contract. There are some other terms and conditions based on which this contract can become some kind of variabilities there. Now, what is the contract revenue? Because here what happens is, when we look at percentage completion, first we need to know what is the revenue from the contract. So one need to first determine what is the revenue. then determine what is the cost, and then determine the profit and the percentage. So the first and foremost is what is the revenue. Again, certainty. So initial amount agreed in the contract, which is a certainty. Now there is a variation in the work. So if there is a design which changes, correct, or there is a delay at the end of say contractee, or there is a delay on the part of contractor. So there is a either the damages which are there, or if there is a early completion, there is an incentive. So any variation in the original contract, if there is any claim could be, as I said, claim for delays, claim for escalation of the pricing, or there are some incentive payments for the early completion, or there are damages for delayed completion. If it is probable that it will result in a revenue, and it is capable of being reliably measured, if only if these two conditions are met, then only variation in the contract claim. Of course, these conditions are important even in the original contract revenue, but even for the variation, because a lot of times there is a claim which has been filed by the contractor, but either the contractee is not agreeing or asking for information, or it is pending for some approvals. So there are various terms and conditions. So original contract is agreed, but subsequent claims goes into a closer scrutiny, and hence if it is probable that the contractee will agree to the claims and it can be measured, then it can be considered as a contract revenue. Now comes to what is the contract cost. So contract costs are something which is directly related to the specific contract. So labor at the site, material which are consumed at the site, depreciation of plant and machinery used for the site, all approvals for the site, that is all a direct. However, if the company has say any construction overheads, so any engineering department or a designing department which caters to various contracts, then it's a construction overheads. So those construction overheads which are attributable to the construction activity and can be allocated to the contract. So no inefficiencies should go, but it can be attributable to the contract. Then on a reasonable basis, it's like inventory. We say inventory overhead. It's like a construction overheads. Those overheads can be considered as a part of construction cost. And if there are any other costs which are specifically chargeable to the customer, correct, then those are part of the contract cost as well as contract revenue. So it is both sides which are there. However, cost which cannot be attributed or attributed to the contract activity and cannot be allocated to the contracts are excluded. And one very important thing is any marketing cost, selling cost, right? Those are not related to the construction activity. Those are related to the sales activity. Any R&D cost, that is not a contract cost. That is to be charged off as and when incurred. So if the company gives the advertisement, if the company for the project, or the whole marketing department which the company maintains, it is not the cost which is attributable to the contract. It is the selling cost and cannot be considered as a part of contract cost. Borrowing cost, similar concept what we know under AS2. So borrowing cost which are incurred in connection with the borrowing of the funds, which can be attributable to the contract activity in general or can be allocated to the specific contract, can be considered as a part of contract cost, not otherwise. How do we estimate contract revenue? Correct. So if the final out of the contract, ultimately one is to, again, the concept is the similar. Is the final outcome of the contract is correct, and is it reasonably certain that we will get the revenue? So if the outcome of the contract can be reasonably estimated, reliably estimated, then recognize revenue and the cost as per percentage of completion method. And what are the percentage of completion method, we'll see. And if it cannot be reliably estimated, right, because it's just the starting, it's a large project and we have started incurring the cost, so one cannot estimate the final outcome of the contract, but at least we are confident, the company is confident that it will not incur into losses. So earlier, so this is a revised AS7. In the earlier AS7, there was a guidance which was given, is normally till the contract is progressed to 20 to 25%. Normally the revenue is not recognized. This is a revised AS7. This got revised also many years back. Here that that guidance is not there, and hence each contract one has to evaluate. But if it cannot be reliably estimated, but the company is confident that it will not incur in losses, then it can recognize revenue to the extent of contract cost incurred. So there is no profit which is recognized. However, if there are any losses, those losses are recognized immediately. So any loss, for example, if the company undertakes a contract just to get the credential, or just to beat the competition, and takes the contract at a loss, the day the contract is signed, that loss needs to be provided. However, the revenue and the profit will be recognized over the period of the contract. But any loss at any point of time, there is a loss. That loss should be provided immediately without any further waiting for any further event. How do we recognize this method, percentage completion? So there are two methods. First is the input. In input, it can be, by and large, it is considered on the cost. So what is the cost incurred to total contract cost? And output may be more, so this is input is more objective. Output based is more subjective, but maybe more relevant. It is based on the actual physical work done. We accountant, we look at the objective criteria, so we are more comfortable with input, but output may be better because based on the physical completion of work, based on the work which is certified by the expert, what is the percentage? So that is the output based method. If it is output based method, then one has to rely on the work of the expert and undertake all the auditing procedure to evaluate with how we as auditors have relied on the work of expert. Now, contract cost relating to future contract activity recognized as contract work in progress as long as probable of recovery. So any contract cost, correct. So for example, if we have given any advance to the contractor, or the contractor in turn has given any advance to some other labor contractor or some other contractor, or advance for material, it will be recognized as contract work in progress as long as it is probable of recovery. Uh, if the doubt about collab, same thing about AS9. If the when recognizing revenue, if it is reasonably certain, then the contract revenue is recognized. But if that collectibility is in doubt subsequent to recognition of revenue, then it is written off as bad debt and it is not adjusted against revenue. And the last and the most important is the progress payments and payment in advance is not reflecting the work performed. So however money which is been received, it's a money received or paid, but it is not reflective of the work performed. Now let's look at a couple of examples. A Limited is engaged in the construction contract with expected sales of 10 lakhs. So there is a 10 lakhs expected contract revenue. Now there is a case one. It has incurred cost of rupees 4 lakhs, including 50,000 in respect of unapplied raw material. And 3 lakhs is the best estimate of cost to complete the contract. So 10 lakhs is the revenue. 4 lakh has been incurred, out of which 50 lakh is material at site not applied, or material in hand not applied, and 3 lakhs. So total estimated cost is 7 lakhs. Mind you, in contract accounting, when this is there, cost to complete, the estimation process is very, very important. Please review it very, very carefully. Look at the past trend. Look at the basis on which management reviews the cost to complete, because profits can move from one period to another period just because of changing the estimate. And if you look at in the past, some large companies had some irregularities based on which this cost to complete was not done appropriately, and the revenue and the profits were recognized not in the period in which they should have been recognized, but in some other period. So here in the first case, any take on what will be the revenue which will be recognized in this? Harish, advance received will be considered as a liability. So in this first case, any takers on how the revenue, what will be the revenue which will get recognized? So here first one will have to look at what is the cost which is incurred. Correct. What is the contract cost? Correct. Sandeep. So why 35%, Sandeep? Sorry, so because it is not, so it is 3.5 lakhs. So one is to recognize revenue based on the cost incurred. Now the cost incurred is 3.5 lakhs, right? And what is the total cost? Estimated cost is 7 lakhs. So the contract revenue to be recognized will be 50%. 3.5 lakhs is the cost which is actually incurred. That doesn't mean that cost one has to so one is the percentage of cost one has to look at. What is the percentage of cost? It is 50%. And hence 50% of 10 lakhs, which is 5 lakhs, which will be recognized as revenue. The next is, so that was on the input method. Hope you got, Sandeep. Yeah. The next one is on that was on input method. The now is on the output method, that the independent surveyor is certified at the period end that contract is 55% complete and retention amount is 5%. Then how much revenue which needs to be recognized? So correct. So now 50, even if retention is there, 55% is complete and hence 55% of the revenue will be recognized. And in the third scenario, A's best estimate of physical proportion of work it has completed is that of 60%. Correct. Now here the issue is, as I said, it always becomes difficult when the company is recognizing on its own, when the expert is recognizing. So one gets a better comfort because expert is, certified. And as I said, we are more comfortable if it is objective criteria, which is input based. So input based may not be the correct or the ideal way of recognizing revenue, but objective criteria wise, it's the best one. But if only company recognizes 60% of the revenue based on its own estimate, then we'll have to do a lot of audit to understand what is the process which the company has adopted, what is the who prepares, who signs off, what kind of discussions are happening, because otherwise it's all subjective. Company can manipulate revenue in the period in which it wants to recognize revenue. So please be mindful of that. Now, since this is a estimate which we get in, and the estimate goes on changing, so one has to be very careful, as I said, that what is the balance cost to complete. And whenever the estimate changes, then those changes happen in the period in which the estimate changes. And in case of, I'm sorry for the repetition, but in case of contract accounting, where there is a large contracts, long-term contracts, the estimation process becomes a very, very key auditing procedure. And one has to be very, very careful, because some change here and there, calculation error, and the revenue can get recognized in the wrong accounting period. I've picked up this example. It's a good example. It is directly coming from the standard. So, I'll just run it little faster. I'm hoping that everybody's, run through the standard. But it's important, as I said, it gives the clarity about how the accounting needs to be done, how the changes in the estimate needs to be done, when the changes in the estimate needs to be accounted. So here the case study is that there is a contract of 9,000. Contractor's initial estimate is 8,000, and it will take 3 years to build the bridge. By the end of first year, the contractor estimate of contract cost has increased to 8050, because it's an estimate ultimately. So at the end of year one, this has changed. In year two, customer approves variation because of a contract. The variation always happens, changes, variation, design, resulting into increase in the revenue of 200 crore. Because of this 200 crore, there is also additional cost of 150 crore. And at the end of 2 years, the costs incurred include 100 crore for standard material stored at the site to be used in year 3. Because it's the material is at site, it is not yet used. So how do we account for revenue? Just repeating, 9,000 is the revenue, 8,000 is the estimated cost. At the end of year one, the cost increased to 8050. So 8,000 increased to 8050. There is a variation, which variation is increased to by 200 crores of revenue, 150 crore of expenses, and there is 100 crore of material stored inside to be used in year three to complete. So it cost incurred but not implemented. At the cost which is incurred in year one, year two, year three is this is the cost which is incurred. The idea is that how do we recognize revenue? Since it's numbers which are there, I'm not. I'm just trying. I'll explain rather than somebody writing. Had it been on face to face, that would have been easier. But here I'm just running through the example. So first is, let's look at over the period what is the revenue. So at the end of year one, the revenue is 9,000. Cost incurred till date is 2093, which is coming from here. Cost incurred is coming from here, right? So 2093 is cost incurred. At the end of year one, 8050 is the cost. So though original cost was 8,000, 8050 was the cost. So 9,000, originally 9,000 was the revenue and 8,000 was the cost. But at the end of year one, 9,000 is the revenue and 8050 is the cost. And hence the estimated profit is 950. And the percentage completion is considering cost to estimated cost. So what is the cost incurred is 2093. What is the estimated cost is 8050, and hence 26% is the one which is complete. Coming year two, at the end of year two, there is an increase of 200 crore, which is agreed. So contract revenue is increased to 9,200. Cost incurred is actual cost incurred. And since 8020, which is the cost, which is 150 crore of this additional cost plus 50 crore of this additional cost. So 8,200 is total cost estimated, and estimated profit becomes 1,000. 950 becomes 1,000. And year three, all these costs are incurred, and accordingly, it is 100% complete. Now let's look at year to year how this will get accounted. So year one, the expenses incurred were 2093, and which is 26% of the cost, and hence the revenue will be 26%. So year one, the revenue recognition, contract revenue in the P&L will be 2340, expense 2093, profit 240. At the end of year two, we saw the expense of 6,168. However, 100 crore was not applied, and hence the actual contract cost incurred was 6068. 6068 on the contract cost of 8200 comes to 74%. So the contract revenue will be 74% of 9,200. 9,200 was this contract revenue. However, this is at the end of year two. However, this was already accounted in the previous year, which is 2340, 2093, which was the cost, and the 247 crore of profit is already recognized, and hence year to date, period to date, minus recognized in the prior period will be the revenue which will be recognized in the current year. Similarly, cost and similarly profit. Similarly, at the end of 3 years, the 100% revenue will get recognized, of which that recognized in the previous up to previous year will get reduced and the balance will get recognized in the third year. Similarly, cost, similarly profits. So it's a very simple and a good way of explaining, and hence I have not created any example of how this gets evaluated, calculated. But it takes care of the original cost, increase in the cost, change. So there is a variation which is there, and it's over the period. I've created couple of ones which is with some variation, and this I would request you to read and give me your response. So it is same, the facts is the same, 9,000, original 9,000 as the contract revenue expected, 8,000 is the contract cost expected, and it will take 3 years. But at the end of year 1, the contractor's estimate of contract cost is increased by 8,500 crores. Right? Contractor requested customer to approve the additional contract cost and has submitted all the documents to the customer to evaluate. And contractor has incurred 800 crores during year 1. So idea, the purpose of this is that my estimate has changed from 8,000 to 8,500. Since my estimate has changed, I have put up a claim to the customer saying this is my additional cost and why don't you approve? The customer is not approved. So what needs to be done? So can I recognize 500 crore as the cost as well as revenue, or I do not recognize any of them, or I recognize one of them? Any take? Mind you, if I recognize 8,500 as the cost, my contract revenue and 8,500 and this 500 crore as revenue, so additional 500 crore cost and revenue, should I consider, or should I not consider both additional 500 crores in contract cost or revenue, or I have to consider this in cost and not in revenue? So idea is that percentage of completion will change depending on this variation which is there. So anybody, any guesses? Correct, Vinod. So contract cost is considered because estimate has changed from 8,000 to 8,500. But so but the customer is not approved. Hence, in my revenue recognition, I will have to say 800, which is actually incurred, divide by what is my estimated cost, which is 8,500 and not 8,000. So my revenue recognition will be less than 10%. And in my contract revenue, it is only 9,000 and not 9,500. Hence, we will be conservative in recognizing revenue in year 1. Now further twist. Instead of 8,500, now at the end of year 2, contractor's estimate of contract cost has increased to 9,100. So 8,000 increased to 8,500 year 1, 9,100 year 2. The contractor requested customer to approve additional contract cost of 600 crore in addition to rupees 500 crore because there is a pending approval of 1100 crore which is pending. Customer could not evaluate additional cost due to COVID pandemic because the contractor had given, but it could not be evaluated by the customer because there was suddenly a pandemic came. Now the contractor expects cost to increase by 50 crores in the third year due to COVID pandemic. So how should contractor account for contract revenue and contract cost at the year end, year 2 out of the following options? So I'm giving you these 3 options. So consider that customer will approve additional cost for the reasons mentioned because it was COVID. Logical, customer was contractor was sympathetic, customer had the constraint, and hence contractor can assume that customer will approve the additional cost. Or in the second one, ignore the approval of additional cost. That is second option and provide loss of 100. Now because my revenue is only 9,000, but my contract cost is 9,100. If there is, as I said, if there is a loss, then that loss should be provided immediately. So at the end of second year, my cost is 9,100. So I should provide for 100 crore as a loss. Or that the contractor expects because of COVID came in suddenly in March, April, and hence there is an increase in the cost of 50, and hence ignore the approval additional cost and provide loss of 150. So 3 options. Consider because of COVID that customer will approve. Customer was sympathetic to all this, or look at what was the cost estimate at the year 2 and provide for 100 crore as a loss, or consider the expected additional cost of 50 crore due to COVID and provide for additional loss of 150 crore. Any takers? No one. Correct, Sandeep. So idea is that I wanted to cover a couple of things. Because of COVID, there is no change in the auditing procedure, right? The auditing procedure remains the same. All the guidance around the COVID procedures, which reinforce the existing auditing standards, number one. There is no change in the accounting. Accounting also stays. It's not nowhere any of the regulators have said that because of COVID, this is the change in the accounting. All the regulators have given guidance reinforcing the existing accounting and auditing standards. And as per the concept, if there is a loss, please provide for the loss immediately. And then Sandeep, you are right on the dot, is we need to provide 150 crore immediately at the end of year 2. This is all the presentation. I'm not getting into it. On the presentation, one can read. Let me come to the lease standard. So lease standard in India's, it has in that sense lots its significance because all the split between operating lease and finance lease and the accounting is standardized under India's. However, since we are looking at accounting standards where all the guidance is around what is operating lease, what is finance lease, and how do one evaluate the operating lease, finance lease, how the accounting changes for operating and finance lease, and hence this presentation is based on the accounting standard. As I said, in days the difference is been eliminated. Both leases are on the balance sheet. So lease is an agreement whereby lessor conveys to the lessee in return for the payment of series of payment right to use assets for an agreed period of time. So it's a right of use of asset, not services. It's a right of use of asset where the lease comes into play. In case of finance lease, uh, transfers substantially all the risk and reward incident to the ownership. So if it is a finance lease, the risk and reward belongs to the lessee. So it may be structured in a different way, but the risk and reward. So again, one has to look into the agreement. One has to look into the contract to evaluate whether it's a finance lease or operating lease. Because if it is does not do it, then it is a operating lease. The one is, these are the few definitions which I thought there are many other definitions, but which I thought was critical, and hence I'm discussing. What is the economic life? So economic life is the period over which an asset is expected to be economically used by one or more users. It is important. Economic life is one or more users use that asset, and useful life is the period over which the lessee is expected to use. Right. So the issue is, for example, company may have a conservative policy of providing and estimating useful life, and hence company may provide for some assets, say over a period of 5 years, but those assets can be used by somebody else over a period of next 4 years. So the economic life is 9 years. Useful life for the lessee is 5 years. That's a difference. And it's an important difference. We'll see in a couple of examples. And the lease term is the non-cancelable period for which the lessee has agreed to take on lease asset together with further periods for which the lessee has option to continue the lease asset. So the idea is, what is the lease term? The lease term is, number one, what is the non-cancelable period? So I'm taking office premises on lease for a period of 5 years. So it's a non-cancelable period. The next is, lessee has the option to continue that lease for a further period of 5 years. So lease term is 10 years. And the third is, after 10 years, both lessee and lessor will mutually agree for the further period and the amount. Hence, that further last 5 years is not to be considered. First 5 years and second 5 years. So lease term is 10 years. Some important this which should tell us that this is a finance lease or operating lease, though in paper it may not appear. So ultimately one has to look at risk and reward, right? So for example, if the lease is for, so lease of the car, let's think about it, is, so lease term transfers ownership of the asset to the lessee by the end of the lease term. So we go to either the bank is not, but we may go to other agency. They may structure the lease the way we want. But if at the end of the lease period, right, it transfer the ownership of the asset to the lessee, the ownership of the car, then it's a finance lease. If it is a finance lease, what happens? The lessee will account for and will see asset as well as liability. The next is, if the lessee has the option to purchase the asset at a price which is expected to be sufficiently lower than the fair value at the date of the option becomes exercisable. So if it says that, this is for the period of 5 years, at the end of 5 years, lessee can purchase it at X value. That X value is significantly lower then expected fair value at the end of 5 years. If that is the term, then it is a finance lease. This is important, and I have dealt with several examples in this, that the lease term is for the major part of the economic life of the asset, even if the title is not transferred. Economic life, we have seen what is economic life. Economic life is of the asset. Useful life is of that of the lessee. So if the lease term is the major part of the economic life of the asset, then it's a finance lease, not a operating lease. The next is lease payment substantially equal the fair value. So if I say for the payment of the car, whatever is the lease payments, with whether it is 5 years, 2 years, 3 years, but that is the fair value of present value of the future lease payments, then it's a finance lease. And so and so forth. What I'm saying is, please look at what are the rights of the lessee, what are the rights of the lessor, and if in substance it transfers the risk of the ownership to the lessee, it is a finance lease. See, the issue which is there is if it is a finance lease, and sorry. Because the issue which is there is if it is a finance lease, then the lessee will recognize both assets and liabilities at the present value of the minimum lease payments. That means there is a liability which sits on the balance sheet. And many times the leveraged lessees does not want, because it defaults on their borrowing obligations, borrowing terms. And hence this, the lease is structured in such a way that it is an operating lease. If it is an operating lease, then the lessee only makes the payment, and there is no liability which sits on the balance sheet of lessee. So in case of, as I said, finance lease, lessee will recognize both assets and liabilities at the present value. Since the asset belongs to the lessee, that means it will amortize the asset over its useful life, not economic life. Because lessee's useful life is say 5 years, economic life may be more. So it will amortize over a period of 5 years. And lease payments, because there is a liability, these payments are bifurcated between settlement of a liability and the balance is the interest payment. And in the books of the lessor, the net investment in lease is a loan, and the lease payments are bifurcated into repayment of loan and interest income. And many times in the case of a structured transaction, it's a catch-22 if finance lease is structured as an operating lease, because in case of a lessee, it brings liability on the balance sheet, which is against any of the debt covenant. And in case of lessor may have taken loan on the basis of security of the asset. That security is not on the balance sheet. It is because banks or lenders may have given loan based on the asset, but that asset is not in the balance sheet as it is shown as a loan, and hence it's a challenge for both lessor and lessee, and hence this classification of both whether operating lease or finance lease becomes a very, very important and critical in such situation. In case of operating lease, we saw recognize lease payments as expense over the lease on a straight line basis. And in case of lessor owns the asset, amortizes, and lease receipts are income over the lease term. Let us take some case study again. A Limited is a lessor, enters into lease arrangement with B Limited lessee for leasing car. Key terms of the lease are as under. fair value of the car at the inception is 30 lakhs. So 30 lakhs is the fair value of the car. Lease term is for a period of 5 years. At the end of lease term, fair value of the car is expected to be 10 lakhs. Now, there is a lot of value in resale. You would have seen specifically in COVID. So fair value is significant. B has option to purchase the car at the end of lease term for 5 lakhs. So is it a finance lease or a operating lease? Anybody? We discussed all this. Correct, Bhavesh. It's a finance lease. It's the easier one. I'm saying car you will feel, but I'd be mindful nowadays. Companies have an operating lease of cars also, but this is a easier one. Let's look at the next one. A Limited is a lessor enters into lease arrangement with B Limited for a leasing machine. It's a machine now. Key terms of the lease are fair value of the machine at the date of inception is 50 years, 50 lakhs. Lease term is for a period of 15 years. Sorry, this is the other way around. This is 10 years. Lease term is for a period of 10 years. Economic life of the machine is 15 years. Anybody? There is a machine which has been taken. The lease term is for a period of 10 years, which is, as I said, non-cancelable period plus that at the option of the lessee. And the economic life of the machine is 15 years. So Sandeep, so you said finance lease, but here the important is lease term is 10 years. Economic life, the life of this is 15 years. And hence it is likely to be operating lease. No, Bhavesh, it is not more than 50% of economic life, hence a finance lease. Because there is no clear guidance. I think US GAAP had some guidance, which was less than 75%. But here, that also is not there. So I'm saying this is more likely to be operating lease than the finance lease. Now let's look at the similar example where the lease term is 15 years and the economic life of machine is 16 years. Would you call it finance lease or a operating lease? Yes, Sandeep, you're right. So it's a finance lease. Hence, one has to be, uh, very read those agreements very carefully. They appear to be different. Actually, it may be different. And the idea is that there are some debt covenants. There are some covenants which the one is violating. In fact, I analyzed one very interesting issue where I don't know whether that I've kept it as an example. Let me see. Otherwise, Okay, this is not the case. So I had examined very interesting issue where the company had computers. Should be there. Okay, sorry, it's not there. So company had computers, and the useful life of computers was, as per the company, 3 years. So company would replace those computers over a period of 3 years. Now it took the computers on an operating lease over for a period of 3 years. And the issue was whether it is a finance lease or operating lease. When this was examined, I think one important thing which came up was that though the useful life, because the company wanted the latest computers to be used, the useful life of that computers is actually 6 years. So the company which was giving this machine on lease was actually, using it and giving it on lease to other parties over a period of next, 3 years, and their margin was coming out of this. So first 3 years they were not making money. The next 3 years they were making enough money to catch up for first 3 years and the next 3 years. And hence it was concluded it's an operating lease, not a finance lease. Now this is a different way where the companies raise funds. And here the issue is that if I have asset, the company has asset, and company is in need of funds, what do one do? Is they sell and lease back. So here the B Limited was in need of funds and has sold one of its assets to A Limited and leased it back. So it's a lease. So I've sold it to A Limited and purchased and leased it back from A Limited. And the issue is that, how do we deal with it? So the key terms of the lease is as under: carrying value is 25 lakhs. Asset is sold for 30 lakhs. Balance useful life of the asset is 10 years and the lease term is 6 years. Correct. So B Limited has asset in its books whose carrying value is 25 lakhs. It is selling for 30 lakhs. The balance useful life is 10 years and it is taking back for 6 years. So would you call it as a, is it a operating lease or a finance lease? So correct, Suman, it's a operating lease. So you are right, because it is 10 years and 6 years, in which case this 5 lakhs will be accounted as a profit when this lease when it is sold, and then this is a operating lease. This will be accounted as a operating lease. Now let's take one more variation of this. Carrying value is 25 lakhs, which is the same. Asset is sold for 20 lakhs. The balance useful life is 10 years and the lease term is 10 years. No, Bhavesh, operating lease is because the useful life of the asset is, and what period over which the B Limited is taking the asset is lesser, and hence it's operating lease. Whether title will get passed or not passed is independent. That is the reason it is a operating lease in the earlier example. Now in this example, I am waiting for the answers. So 25 lakhs is the carrying value, 20 lakhs is the uh, selling price, useful life, lease term is 10 years, and the economic life is also 10 years. So here, I think Pramod, the issue is, so it becomes complex. So it is complex. So first and foremost is one is to evaluate whether that 5 lakhs, why it should not be provided. So is there an impairment? If there is no impairment, then the 5 lakhs can be amortized over a period of 10 years. But if it is an impairment, then 5 lakhs needs to be provided immediately. That is what, because that is an impairment, and hence if there is an asset which is a carrying value and there is an impairment, company may enter into this arrangement, because impairment is a very dirty word. Nobody wants to call it impairment. So they will enter into such arrangement where asset is asset is sold, leased back, and 5 lakhs is not provided. So the loss is not provided, loss is provided over the period. So if there is an impairment, if there is no impairment, so impairment is two bases. One is the selling price, other is value in use. Higher of the two. If higher of the two is the loss should be provided upfront. If it is not a loss, then that 5 lakhs can be provided over the period. Now, instead of 20 lakhs, now in this case, the sale price was 20 lakhs. Now, in this case, the asset sold for 30 lakhs. So 25 lakhs carrying value, 30 lakhs asset sold. So there is a profit of 5 lakhs. Balance useful life is 10 years, lease term is 10 years. How do we account? Come on, Pramod, Harish. Anybody? So, so, so all of you are right, Sandeep, Bhavesh, Pramod. All of you are right. It's a finance lease, but that 5 lakh profit is not to be recognized upfront, because the asset continues to be in the book, and that 5 lakh profit will will be recognized on a systematic basis over the period of 10 years. So the concept is, if it is a loss, impairment loss, that loss needs to be provided upfront. But if it is a profit and it's a finance lease, then that profit needs to be recognized over the period of lease term on some systematic basis. So that was my this on lease. I think the last one, and which should not take much time, is on government grants. So what are government grants? Is some assistance which is provided by the government, and which can be in the form of cash or in kind, and it can be based on the past achievements, or in case or future compliance, and there could be some conditions which are there. So we'll see a lot of government grant which comes, where say based on some investments which are made by the company in the project, or based on some employment which is generated, or based on some additional terms and conditions which are complied with. And the idea is that whether it is a capital grant or an income grant. So one has to look at what are the terms and conditions, right? Because if is there a cost which the company has already incurred to get this grant. So for example, if it is anything relating to say employment generation, then that cost has already been incurred and it is possible to recognize this as income, but that employment condition can be over a period of many years. That company will continue to have employees over a period of say next 15 years, 20 years, and if not, then this grant can be refundable. So whatever are the complications, one has to look at what are the obligations. Have we met the obligations? Are we meeting the obligations? Is it possible that we will there could be challenge? What is the probability of this? Depending on this, and if it is say anything relating to the part of shareholders fund, lot of times the grant is given based on the value of investments made. It need not be straight a capital grant. One has to evaluate each grant, each government, each local authority may have a different, and depending on the scheme, one has to evaluate whether it is a capital or income. If it is capital, then it is shareholders fund. If it is income, then it has to be systematically recognized over the period over which either to match the cost or meet the obligations. But at any point of time, if there is a possibility of giving back money or penalty, that should be provided upfront. If it is a grant which is relating to asset, it is ideally, the issue, and a lot of times this comes into discussion is specifically under Indian GAAP, is whether it should be done on a gross basis or a net basis. So for example, there is a fixed asset, there is a plant which is set up, and there is some subsidy based on the investment. How do we account for the subsidy? Do we apportion and disclose fixed assets on the net basis? And my view is that it should be disclosed on a gross basis, and this grant can come to P&L over the period on some systematic basis, say based on say depreciation charge or the useful life or any other basis. But there are different methods which are there, and both methods are acceptable. If it is any non-monetary grant, so for example land given free of cost, under Indian GAAP, when one can record it out nominal value basis. And if it is any grant related to revenue, what the standard says, it should be accounted as other income or it should be reduced from the expenses. And this in the nature of promoter's contribution should be treated as a capital reserve and should neither be distributed as dividend nor considered as a deferred income. As I said, this is one of the smallest standard. I did not find any complications, and hence I have not given any examples, but I will be happy to take on any questions which any one of you would have. So thank you for participation. I thought, I hope that I have created some discussion. I would be, as I said, I would have been more happy if it was a face-to-face, but given the situation, I tried to create some kind of interaction with you all. And if there are any questions, as I said, I'll be happy to answer.
Thank you, sir. Thank you, sir.
Thank you, thank you, thank you.
Thank you for your
I'm just
time.
Hmm.
The no, no, it was really very crisp and with all the case studies and exhaustive. And the session was really all the cases, everything. It was like a very understandable. And I just say thank you, sir, from on behalf of CA Institute for coming and giving your precious time to us.
thank you, thank you for your kind words, and I hope participants also have similar view. If there are any questions there, I can be reached anytime they want. Thank you.
Sure, sir. In case of
Yeah,
any query, we will mail you. Yes.
sure, sure. Thank you, thank you. Is there any questions?
Thank you, sir.
Yeah, yeah. Okay, thank you, thank you,
Is I'll just check in case. Yeah. Thank you, sir.
thank you, thank you, thank you.
Bye.